Hello, everybody. My name is Christopher Terry, CEO of iMarkets Live. And yes, I got my shirt on backwards to show you don't have to be perfect. I got my Biggie hat, Arsalan John, and Daniel Westby, and Austin Umberger, and oh my gosh, Ben Christopher, and the whole crew was out here. Peter Strombaum, I can't even say his last name. He knows that. They were out here this past week, qualifiers. They did some great work in terms of bringing on teams. I invited them. They were out here for a few days, and they bought me a hat. So, because in the chat room, in our live trading and educational room, um, my nickname, I like Biggie Smalls. I listen to his music, so they bought me the hat. So I wear it all the time now, and I'll never forget them. So I'm going to take myself off the video, and what we're going to do, folks, is we're going to go step by step, and we're going to look at the overall markets, basic stuff like what is Forex, what are the currency pairs. We're going to go through all this information. What is a pip? Just a basic. If you're advanced and this is too slow for you, I don't know, go watch TV. But I think you'd rather be around me, right? So let me take myself off the video. I'm going to put my screen on so you can see it. And what is Forex? So we're going to keep this interactive, and I'm going to basically show you something. So we're going to do, I'm going to bring it here, and I'm going to show you. Okay, keep it simple. On my screen is, as you see, lots of pictures, all right? So if you go to the airport, what is Forex? You go to the airport and you want to go from one country to the other, all right? The airports, they have stuff like this up there, currency exchanges. So if you're going from one country to the other, there's a cost to exchange money. So let's just say you want to go to England right now, okay? And now we're going to go look at the actual charts. So if you go into England and you want to go to England and visit your friends, you go to London, you're going to take your dollar and you're going to buy another currency. Now, you may be in Canada right now, you may be someplace else, but based on the United States, US currency, you're going to go to the currency exchange booth and you want to buy their currency. So it's $1.49, right? $1.49 is what it is, $1.50. So you would go and you say, okay, I want to buy 100 pounds, British pounds, GBP, Great Britain pounds. I want to buy 100 pounds. It would cost you right here times $1.50. So it costs you $150 to buy 100 pounds. And I promise you, when you get to England, you're going to realize that Starbucks is like $10, I went to England last year and I couldn't believe that I was paying $190 for like a Howard Johnson's or something, a Holiday Inn. But the fact is, England has extremely strong currency. And you would take your currency and you would sell the US dollars, you would sell them and buy the British pounds. So you would give them that your 150, you would sell your currency and you would buy the British pounds, and now you have the British pounds in your hand, and you would go to England and spend them. When you come back to the United States, you would sell those British pounds and buy the US currency, and obviously it's like 75 cents to the dollar, right? So you would exchange it back. During that time, there's what's called a bid and the ask, a spread. So right here, you're selling your US currency and you're buying the other currency. And this happens from country to country. Every country can do this. I'm looking for something else here so I can see if I could show you. All right, I'm not going to be able to show you on this. Okay. All right, I thought I would be able to show you here. Oh, right here. Let me just forget that. Let's go back here. Poof. So there is a bid and an ask in everything. So right here you got the British pound has a bid and an ask. So when you're trading currencies, when you're trading Forex, you would have a spread. So the first thing we want to look at, we'll get to that, is number one, we know what Forex is. Forex is basically foreign exchange, the exchange of one currency to the other. As I said, you would go to England and you would sell your dollars and you would buy the British pound. Well, you have other countries. You have, let me just show you all the different currencies, countries. All right, and this again, this is basically basic. If this is way below you or way simple for you, this class is not for you. This is for the guy who doesn't really know anything, and I want to explain it. So here, British pound. So foreign exchange, you're exchanging one country's currency with another country's currency. So the currencies that we work with, you got the US dollar and you have the euro. So the euro is Europe, and they have their own currency. JPY is Japanese yen. These are major currencies, Japanese yen. British pound, the British pound. This is England, United Kingdom. That's their currency. The Australian dollar, that's their currency. The Canadian dollar, Canada, that's their currency. The New Zealand dollar, that's their currency. CHF is a Swiss franc, that's their currency. All right, so you basically have 1, 2, 3, 4, 5, 6. There's one or two more in there. Anyway, there's about 7 major currencies that we work with, and they pair up with the US dollar. So this is considered a pair. The EUR is paired with the US dollar. The Japanese yen is paired with the US dollar. The British pound is paired with the US dollar. The Australian dollar is paired with the US dollar. The Canadian dollar is paired with the US dollar. The New Zealand dollar is paired with the US dollar. Those are major pairs. All right. And you hear the term cross. Cross basically takes the EUR USD and the GBP USD right here. EUR USD and the GBP USD right there. Those are both paired with the US currency. Well, what happens, and I'm not going to get into the calculations, but basically they take these prices and they combine them and they consider themselves a cross, EUR GBP. Okay? So essentially you're taking the US pairs, because the US dollar basically is 85% of all currency. Everything surrounds itself with the US dollar. And then you have those currencies paired together also, but they're called crosses. So where you have the EUR, where you have the symbol with the US dollar, that's considered a pair. So where you go to, where you want to exchange the money. So right here, if you say, I want to go to Europe, you're paying $1.08, all right? But if you want to go to Japanese yen, you're getting 121 yen for your dollar. If you want to go to England, you have to pay $1.49. If you want to go to New Zealand, you're paying 67 cents. So if you're purchasing these currencies, those are the price. The one in the front is the dominant symbol, and that's what you're paying for. Okay, that's the quote actually, right there. See, that's the quote. Now, when you're pairing these up, when you put them together, or here, where you take the EUR USD versus the GBP USD, you create this cross. So you're taking the major pairs and you're crossing them together. And it has a new price. GBP, AUD. So you're taking, and let's start with the top. These are the 30 major symbols. 30 major symbols is all you need. I know some people will tell you only to watch the USD pairs, and that's extremely smart to do. I would suggest that also. But why not take advantage of all the different pairs? Because there's a thing called the spread.
Sometimes
Huh?
5 times you got a loan of 100,000, they go 5 times, 200, or you got into a
How?
million.
Okay. How do we have people speaking on here? Hello. All right. So that's weird. That's weird. So anyway, folks, everybody keep your mic off. All right. So anyway, you got your EUR USD. You're pairing the EUR with the USD. So that's a major pair. Another pair is the USD JPY. This is how much yen you would get for your dollar. British pound USD. This is how much it would cost for you to buy the British pound. Australian dollar, you would pay 71 cents for 1 Australian dollar. Now you have here a cross. You're taking the GBP USD and the USD JPY and you're crossing them, and that's how much they would pay, the Japanese yen would pay for to get a British pound. They would pay this much yen to have 1 British pound, and so on. USD CAD, it's a US dollar versus the Canadian, and all the way down. As you see here, you got the EUR JPY. You're pairing up or crossing the two major countries. I can go on and on and on, but essentially it's the same thing. All right. The Canadians would pay $1.51 to have 1 euro. $1.51 Canadian dollars. Now, some people will tell you to use only the major US pairs because of the spread. Well, there's a couple of trains of thought. Yes, if you're trading such a small time frame, a 5-minute chart or a 15-minute chart, let me see if I can get the example to show you what I mean. What I mean here. Let me just show you the ask line. Okay, and let me just fix this one more time. Okay, so let's take EUR USD. All right, you can see that the spread is not so big here. Here's where the bid is. Here's where the offer is. If we take some of this, another one, where your spreads may be wider, GBP NZD, for example, you can see here that the spread is a bit wider. All right, you can see it up here. It's wider. So people, when they educate you that you do not want to trade all these exotic pairs or pairs that are outside crosses outside the pairs, is because of the spread. And when you trade on a smaller time frame, it's very hard to make up the difference of the spread to make a profit. So the validity is yes. If you're trading on a smaller time frame, an hourly chart or below an hourly chart, you would want to trade only the US pairs. Fine, if you're taking short-term trades. If you're taking trades that may last for hours and for days, the spread really is not a big deal because you're looking for such a big swing that you're giving away a little bit of money on that spread. So keep that in mind. So we definitely want to speak about that. So let's see. We talked about what is Forex, what are the major pairs and crosses, and something very, very important, margin and leverage and how to use it. Guys, one of the most important things we could talk about is margin and leverage and how to use it. Okay, let's talk about this. I know we have, okay. So I'm going to be drawing with this if you just work with me, okay? So in the US, it's a 50 to 1 leverage. 50 to 1 leverage. That's what's legal. All right. So if you have $1,000 in a trading account, you have 50,000 times of $50,000 of leverage, which means you could trade $50,000 worth of currency. Now, that is legally in the United States. All right, that's the law here. There's other companies that give you 500 to 1, and your $1,000 is equivalent to 500,000. I'm going to draw this all out. I'm taking my time. I'm in no rush. If you're in a rush, then just don't worry about it. We're recording this. And then there's other companies that give you 1,000 to 1 leverage. And this is your same $1,000. There's a $1,000 symbol, as they call a rack. All right, here's guys on Facebook. I got 1,000 racks. All right, got $1 million. So you got $1 million to play with. Here's how my interpretation of what I've seen. I think Facebook pretty much is my television at this point, and I watch everybody. And I know for some of you guys also, Facebook's your television. But I love looking there because I learn what other people are doing, and I see where I can maybe highlight or help. So in the case of margin and leverage, in the US, you have what's called leverage and margin. So you're putting 2% down, essentially, to have all this leverage. So if you're looking at the US dollar, all the US pairs, the US dominated pairs, USD, JPY, for example, it costs you $2,000 for a standard lot. It costs you $200 for a mini, and it costs you $20 for a micro. However, when you're looking at, and this is on a 50 to 1 leverage, you're taking 100 to 1, you're taking $2,000, and it's worth 100,000 here in trading. You have $200, it's equal to $10,000 worth of leverage, and 200 is equal to 1,000. But that's 50 to 1, and that's 2%. What do you mean 2%? Well, if you have $2,000 times 50, that's $100,000 you can trade with in terms of currency, and that's that 2%. 2% would be the $2,000. So that's where margin and leverage is. It's essentially the same thing. Now, there are companies that offer much higher leverage, and it's a two-edged sword. I'm going to show you something real quick. Let me just go to this company's website, and I have zero negative to say about any company, please. But at least we're all learning the same way, okay? Very good company. They offer 1,000 to 1 on leverage. That means your $1,000 is worth $1 million in the account. However, if we look here and it says risks, most people come here and go, wow, I can get $1,000, okay? 1,000 times leverage. I could put up $100. I could have 100,000 leverage to play with. You can buy a standard lot. But let's just take a look here. Risks. This is the one thing nobody ever looks at, risks. So even a company Trader's Way, they explain to you what leverage and margin is. They explain all that. But then right here on rule number 4, it says observe capital management rules. These rules aim to restrict losses on every given position. And then it says, most importantly, your losses should be no more than 2% of your deposit. So you're wondering, wait a second, I have $1,000 and it's telling me to only risk $20, 2%. Well, then why are they giving me 1,000 times leverage? That doesn't make sense, right? It just doesn't make sense. How is it they telling me I could have $1 million, $1,000 times 1,000 is $1 million in trading leverage. But why they tell me only keep it to 20 bucks? That doesn't make sense. It's not sexy, first off. I don't get it. And this is where there's conflict of understanding. They're basically telling you legally what you should, the right thing to do. They're saying 2%. So when you take a trade, all right, when you take a trade, let's just say you have $1,000 account, all right? If I could teach you just management rules and risk tonight and nothing else, I believe I can change your trading career where you guys are going to create fortunes, all right? I promise you, just follow along with what I'm telling you, and I'm going to shift your game in a much better way than what you've had before. And honestly, if you're really profitable, you don't need me. But if you're brand new or you've been losing, please listen to Christopher. I'm trying to give you the proper information. All right, so let's just say you had $1,000 to work with, and you wanted to trade the the USD All right, so you took a trade and you want to risk 2%. You did one micro. You did one mini. So you're eating up 10,000. You're eating up $10,000 worth of your 50,000 worth of margin, right? What if you wanted to do, and let's go back. Let's just say you wanted to do a point 0.3, and you're eating up $30,000, right? You're eating up $30,000 worth of leverage out of a standard lot, which is 50,000. You'd be eating up this much. The thing is, you could take your risk and you put so much pips, and now you got a 2% risk, 20 bucks. No matter what, it's 20 bucks on $1,000 cash. That's 2%. Fine. And you want to do another one. And you want to put up 0.7 on something. You've gone over your limit of what you can do here. You've gone over your limit because you put on a 0.3 and now you're trying to put on a 0.7. Even though it's a tight risk, you're still going to get, you're limited because you have the 50 to 1 margin, right? No good. So 1,000 to 1 right here will give you all the margin you want. But what I see is a guy with $1,000 is doing 2, 3, 4, 5 standard lots. Then they make themselves $900, and they consider themselves, guess what? The trading god. They're going to teach everybody to do what they've done. That right there will blow you up in a heartbeat. It's not intended for that. It's not intended for you to start with a $1,000 account, leverage all your money, show everybody you're the trading god because you made 900 bucks in one night, and then we got to do this the right way. And then you have no more account because you took a loss that blew you up, right? The intention to give you all this extra leverage is not for you to blow up. Look, the broker would love you to stay in your seat for a long time. The more you trade, the more money they make. It's only simple. If you stay in your seat trading for a week and you blow up, well, that doesn't make the broker any money. The broker wants you to stay in your seat, have all the leverage. They want to give you full reign and give you all the time you need to be profitable. And you could build your account over a year and 2 years. That's the intention. So if we think about this, let's just get rid of all this stuff right here. All right, let's just get rid of all this here. How do I erase this? I gotta figure out how to erase this. Here we go. That wasn't what I wanted to do. All right, guys, not a problem. We'll just erase it with our eraser, okay? So let me show you what the intention is from the broker, and then let's figure out a little model that you could work with. Everything has to be done in models. Everything has to be done in plans. You can't just do things haphazardly and you don't understand it. So I'm going to kind of wake up you guys a little bit tonight and show you maybe a better model than what you have, or at least something that'll keep you out of trouble. All right. All right. So let's start again. You got $1,000 account, 1,000. Now, with 1,001 leverage that these brokers give you, that you guys are putting all this crazy leverage on it and you're making all this money and then you blow up, we don't want that to happen. I spoke to a guy the other day. He lost a ton of money this way. And I said to him, I got an idea. Let's just try this. Let's understand what the thinking is first. Let's just say you tried to take a position here, the first position, and with $1,000, you did the first position you did a 0.1. All right. You did a mini lot. And now you're in profits here. You're in profits 50 pips. You're in profits. Then you do another position, another mini, and you're in profits 30 pips. And then you did another one, all right? And you did two minis, all right? And this may be at 0. And then eventually now you're up 30 pips. This is 80 pips, and this is 150 pips. Okay. What the point of, and you're doing 2% risk on every one of them, 2%. Just like Traders Way said, I didn't make up their risk. They made up their risk. If you can't read it, let's all read it together. Traders Way says, most importantly, your losses on every given position, right there. Every position, your losses should not exceed 2% of your deposit. What they're saying is, yes, you can have 1,000-to-1 leverage, but use your leverage wisely. That if you get into a trade and it's profitable, that the 1,000-to-1 gives you money so you can trade another position. And when that's profitable, you trade another position. Meanwhile, you can build up a whole portfolio of positions. So where you would work with maybe FXCM and you're limited because you have only a 50-to-1 leverage, and you could take maybe 3 positions totally, or 2 or 3, whatever, or 1. Here, you can continuously build up a portfolio of positions if you're building up swing trades, or what I like to do is I get into a trade, and I don't do this for the live room. I don't do it for the signals. I get into a trade. Let's just say I enter here, and the market goes in my favor, and then it pulls back. I enter again, and I put my break-even stop here, meaning that if I'm plus 4, I mean here to here, I'm plus 2, and I'm minus 2. What this means overall, I'm plus 4 on the whole account right now of points, that I'm going to risk 2 points on this trade, and I'm profitable 2 points on the first position. So first position, second position. You see how you could take the leverage here, you enter in with 2% risk, you're now in the profit. And here, if you lose, if it stops you out, you have a zero risk. You see that? You're risking 2% here, and now you're plus 4% profitable here. And then it goes up, okay? And then it comes down again. And what I'm doing is I'm adding a third here. And I move my stop to here, and now I'm building a position. I do this all the time. Okay, this is how you make huge money in the markets, but you don't do this on a 5-minute chart. You do hourly, 2-hour charts, and I build positions. And what's happening is, because you have a 50-to-1 leverage, there's not much you can do here. But with Talonx or Trader's Way, they're giving you 1,001. You can add, you buy, you can add, and now your risk is here. So you're using up all this percentage on your $1 million worth of leverage and building a position. But you're always keeping a 2% risk at max. That's how you use the leverage, not go in and buy 5 standard lots on $1,000 on one trade and then blow up. That's silly. You don't do that. If you use this model, what I'm telling you right here, you can create fortunes and be sustainable forever. Utilizing the major leverage, you're sustainable. You can never get kicked out if you only kick 2% risk. Now, I know there's some of you guys that say, well, I like doing large size. Okay, fine. Listen, if you can go and take $500, I'm sorry, 500, and you can make 1,000, well, why not take off, 800 bucks here and put it to another account? All right, put in another account. Take your 500, now you got 700. And then go make another $1,000 and take another 800 or 900 or 1,000 and put it on the side and build up a bigger account where you have lower risk while your smaller account is taking higher risk. No problem. I have no problem with that. Listen, I live in Las Vegas. I live at a resort. I live in a building that the casinos are downstairs. I can go downstairs right now at 9 o'clock Eastern time, and it's full of people gambling at the tables. What they're doing is they may have 50,000 in the bank, but they're taking 500, 1,000 and putting it at risk. They need to get that out. You need to have that excitement. You need to be considered a trader. So what? If you're putting 500 bucks up and you want to be aggressive, fine. But if you blow that up, that's risk capital. That's basically your play money. I want you to take one account to enjoy, have fun, be aggressive, but when you make a profit, you put it into a bigger account. And you treat that bigger account as though you're managing money for a client. This is the most important topic we could talk about tonight, which is margin, leverage, and risk. Margin and leverage are the most important topic we could talk about because this is where everybody loses their money. You now have a model that will keep you sustainable for the rest of your life if you listen to me, all right? And you watch this over and over again. Always adhere to the 2% risk. Always, always, always. And also, there's nothing wrong with heavy leverage. It's just that you got to know how to use it. And here, no problem taking a small amount or 200 bucks, whatever you want to do. If you build an account up, take profits off of there and put them here. Look, I can go down to the casino right now. I could take 500 bucks. I can make 100. I can make 200, 500. I take it. I put it in my pocket, and I put my $500 in chips on the table again, and I go back to 500 bucks. I make 100, 200 bucks. I put that in my pocket, and I go back to 500 bucks. All right? You take the little profits on heavy leverage, put them in another account. Before you know it, you have a lot of money. All right? Before you know it, you have a lot of money. If we go back, all right? No, I'm not going to do it here. All right, so that's number one. That's the third thing we talk about. All right, so real important, guys. We want to understand margin and leverage. Let's go back to the charts. All right, let's go back to the charts. So we have we know what FOREX is. We know what the major pairs and the major crosses are. Discuss that. If you just came in and you're late, don't worry about it. We still got a lot more to do here. Now we look at what is a pip. A pip is percentage in points, however it may be. Basically, the pip value used to be the smallest increment that prices can move. Now you have what's called a sub-pip. Sub-pip. So let me take my little pen here and let's see. All right, 1.08736. So let's just say on the standard lot, which is the highest lot you can use, you're leveraging $100,000. Let's just go here. Let's do this one. Where is it? Nope. Let's leave it there. That's fine. The standard lot is the highest lot you can use, and that would be the pip. The fourth digit over is the pip. The fourth digit over is the pip. When you're looking at Japanese yen, it's the second digit over. When you're looking at British pound, it's the fourth digit. That's called the pip. For a standard lot, when prices go up and down, that's $10 per pip. So if you were to buy them at 74 and it goes to 75, that's 1 pip, that's $10 profit. Now the last number, the fifth number, is the hold on a second, guys. Let me just hold on a second. Let me just okay. So the final number is the sub pip. All right, the sub pip. This is a dollar. All right. So on a standard lot, when the pip goes from 74 to 75, that's 1 pip. The sub pip is $1. So let's just say right here, it went from 74 to 74.4. That's $4. Okay. So every time that moves, that is a pip. That's the smallest increment that is traded where you can make a profit or loss. But in the past like 2 years or whatever, they've added that sub pip where now brokers include that in the trading. All right, that is a pip. Then there's another one called lot sizes, and I'm going to do this right here in front of you. Okay, let's do this. Let's do view, terminal. Let's do trade. Okay, so let's do the smallest. Oops, the smallest lot. Let's buy. All right, hopefully this works. All right, okay. What we just did was we bought the smallest lot available. That's called a micro. A micro is leveraging $1,000. You're leveraging $1,000 for that particular right here. See 1,000? You're leveraging $1,000 worth of volume for one micro lot. That's the smallest amount. Each pip is 10 cents. So on the right, you can see 20. That's 2 pips right there. So between the spread and the bid and ask, as we looked at before, there's a bid and ask. I'll explain that again. Don't worry about it. We could see that the smallest size, and that right there, see that? It's 10 cents. That's the smallest pip size. Within that, you have sub pips. So right there, 0.1, that's actually 1 pip. Now it's 1.17 cents. That's 1 pip, 7 sub pips. The next size is a mini lot. The mini lot is based on $10,000 worth of leverage. So the first one we had was $20 worth of volume, $20 worth of sorry, your margin. Right here you see 11,000. You're taking the micro and the mini. Let's get admitted to micro. All right, let's go back to the mini. The mini, you are leveraging exposure $217 on the standard lot. Now this is for FXEM. This is a 50 to 1 account. I'm sure if we did this with Trader's Way, it would be like 2 cents. But your volume is 10,000. So trade sizes are your mini, your micro, and your standard. Now on a mini lot, every pip is $1. So right here you have 2.3 pips, 2.2 pips. See that? Every movement is 1 pip is $1. Let's get rid of that. And now we're going to go to standard lot. Standard lot 1.0, and this is on MetaTrader 4, is basically, where we go, it's $10 right here, $10 per pip. Each sub pip is $1. So there's 10 sub pips within 10 sub pips within 1 pip. There's $10, 10 increments of $1 to add up 1 pip, which is $10. So when the pips move, when 71 goes to 72, that's $20. So that is a lot size. There's 3 lot sizes, and that's how that works. Now, the other thing is called a spread. The spread is the difference between the bid and ask. So right here, I'm going to have to stop the screen here so we all can be on the same page. All right, so right there, let's just take a look at this. This is, we're catching it right here. It looks like a 0.3 spread on this account right here. Let's take a look at something different. Let's take a look at the GBP USD. All right. Boop. All right. Looks like 9/10 of a pip. So some companies where you have the spread is wider, it may be 2 pips or 3 pips. That's the spread. The difference between the bid and ask. The difference between the bid and ask is called the spread. Okay, let's see what else we got. I'm gonna have a little bit of water. Put you guys on video again. Hey everybody, it's taking a moment break. So if everybody wants to get up and maybe take a moment and go out and stretch up a little bit, go to the bathroom, take the time to do that now. We're going to take a couple of minutes, relax, and then we'll come back in the next 3 minutes and we'll do this. Okay, so why don't you do this? Go take a minute or 2 or 3 and then come back and let's continue our class. Fair enough? I'm drinking some water. All right, we got a lot of people here. It's very exciting. We're going to continue to talk about what's the best sessions to trade, what are markets, what are limits, trading versus investing, the trading line. When I show you that, it's going to blow your mind. I'm going to show you how to set up the charts. I'm going to show you how to use the tools of MetaTrader. So stay here, don't leave. We got more important stuff coming that you're really going to love. All right, so just again, go up, go to the bathroom, go get yourself some water. I know Chris has been yapping, but it's a 2-hour class. We got an hour left, and quite honestly, I'm not going to stop until we complete it, so I don't care how long it takes. I want everybody to have the best information, the most information possible, at least from the basics going forward. So far, what we talked about is what is FOREX, what are the major pairs and crosses, what is a pip, what's a lot size, what's a spread, and we'll get into the other things going forward. So we'll give this like another minute or 2, and then we'll come back and we're going to rock the charts even further. All right. So give me a minute also. I'm going to step away from the computer. Be right back. Okay, everybody, let's get going. Let's get back to what we were talking about, and we're going to talk about what the best sessions are to trade. Essentially, folks, we all know that anybody's in the markets, there's always key openings in the market. People like to trade the London session. People like to trade the New York session. Those seems to be the best sessions to trade. The London session, which is 3 a.m. Eastern time, is when everything really starts. Okay, the day really starts at the London session. You can take Australia, Sydney, Tokyo, all that stuff, put it aside. The best, most action starts at the London session. So from 3 a.m. Eastern, now I like to look 2 hours prior to that. I do. I've always liked to look 2 hours prior. So 1 a.m. or 1:30, anytime around that time going forward, that's really where, if you want to trade the evening sessions, you want to be. You want to be prepared and look at charts prior to the London session. You want to know where your support levels are, where your resistance levels are. You really want to be on top of all of that. Now, if you're a brand new trader, it shouldn't matter to you right away. But if you're trading these hourly charts, if you're trading these 15-minute charts, you need to have understand the volatility that comes along with that. Where if you're trading from an hourly, if you're trading a 4-hour or daily chart, it doesn't matter the session, quite honestly. It doesn't matter. Take a look. It doesn't matter. You know what? If you're looking at such a higher time frame, it really does not matter what time you get into the market. Anything below an hourly time frame, then you got to be concerned about the time factor with the London. And then you have New York open at 8 o'clock. So between the London and New York, you have certain type of events, news events, exchanges, interest rate changes, unemployment from different countries. Fine. Then from 8 o'clock to about, I'd say 10 o'clock, that's okay to trade. So really 1 a.m. to about 10 a.m., you got about 9 hours worth of good area of opportunity to trade. That's not saying that if something happens at 2 or 3 o'clock in the afternoon, that if it triggers a trade on one of your time frames, your higher time frames, that you should not trade that. That's fine. If you're looking for a zone to trade, if this was the zone to trade and that's your support, your resistance and your risk is up here, then by all means, if it hits here at 2 o'clock in the afternoon, it is what it is. But the lower time frame traders, London, 3 o'clock, I like to start an hour or two before, and then take that into around 10 o'clock in the morning. For those in my live trading room, for those, so you know, I'm going to be kicking off after the new year, trading the London session into the New York and after. So I'm changing my little sleeping habits there so I can be with you from 2 o'clock in the morning to about 3, and then we'll take a little break, and then we'll come back at 8 o'clock and we'll work the New York session. So those two times right there, most important. The New York time is right as what they call the Globex session, where you have the DAX, which is the European section, the Asian markets and the US markets all come together. And then from that point, for the next couple of hours, the European sessions fade off, the Asian sessions fade off. It's all US into the rest of the day. So 1 a.m. to 10 a.m., perfect, the best times. Or you got the 3 o'clock London, 8 o'clock New York session. So what is a market order? What is a limit order? What is a stop order? What is a take profit? All right, I'm going to show you this, guys. We're using MetaTrader 4. MetaTrader 4. Let's take a look. First thing we're going to talk about, what is a market order? If you buy the market, let's just say we're going to buy. What you're doing here, and I want you to show this. You see where the bid is, you're buying higher. So in reality, the offer, the ask, should be higher than the bid. Like, what are you asking for it? I'm asking $1,000. Well, I want to buy it at 900. The buy is the bid, the ask is the offer. right? So if you want to buy a car and they're offering, they're saying, okay, they're asking $10,000. And you say, well, I'll give you a bid. I'll give you a bid at, 9,800. So that's reality. In Forex, things get a little twisted, where the ask or the bid, the buy is actually the ask. They have it backwards, okay? So, and that is because for the whole exchange rate thing. If you look at futures, and let me see if I could show you an example on the futures market. All right, this right here is something we do every day. Our trading. I was pointing out before, but let me show you something on the futures market. And for the guy who made a video on Periscope that says I don't know how to trade, see this right here? Here's a $3,000 account, and here's what we did last week. A few days. So that's actually real money, believe it or not. But I turned. Oh, this is off. All right, so let me turn this on and connect to the other platform. Okay. All right, so I'll put it up on. So let me show you here the difference. All right, let me just show you the difference, guys. I'll show you the difference between bid and ask and the bid and ask, two different markets. Okay, we're on simulator, we're good. Okay. I gotta fix this. I'm sorry about that. Let me just disconnect things again. Okay, we got it on global simulation. All right, let me pull this offline for a minute, and I'm going to reboot it, and that way you guys can see everything. I just don't want to reboot it right there. So file, nope. And let me reboot that, guys, and I'm going to show you the difference between in the Forex markets and the futures markets in terms of a bid and ask of some people are so funny. Oh my God. Okay, I'll get back to that. Once it reloads, I'll show you what it means. But I'll get back to the bid and ask in a minute. I'm going to show you what the different orders are. Number one, you can do a limit order. What is a limit order? Well, let's just take this and let's take this to a 5-minute chart. So we're going to do a limit order first. Sell limit, right? 1.09. Okay, right up here is the sell limit. And we could bring it down. You can left mouse click, bring it down. And let's just say if the market gets to this area, you want to sell it right there. If the market gets up here, you want to sell it. That's a sell limit. But let's just say if it gets there and you want to put a stop, you put your stop here. Oops, I'm sorry, here. That's your sell limit. You modify it. And you put your stop loss at 1.09. 09. And then you take your profit and put it at 1.080. Okay. What we have here, folks, is you have a limit, a sell limit, that if the market gets up there, you will sell it. And if you sell it, that's where your stop is going to be. If you sell it here, this is where your target is going to be. So we have a sell limit, a stop loss, and your take profit, all set up in advance. You could do this, okay? Now let me get back to the other chart that I wanted to show you guys. Let me just fix this. and bring it here and fix this like this. Okay, I want to show you something. Real important. Right here, it's right here. You see in the Forex market where you have sell and buy, sell and buy. When you sell it, you're selling the ask. When you're buying the bid. In the Forex markets, you have the Forex and you have Forex futures. This is Forex futures. It's the same exact things. In the Forex market, the spot market, you're selling the higher price. So if I want to sell it, I'd be selling it here. In the futures market, if you put a limit out, you sell it here, you'd have to sell it at the higher number, the lower number. I'm sorry. If you want to sell it, you sell it at the lower number. You see that? In the futures market, you'd be selling at the higher number. So in the futures market, they're a little bit different than the spot market, but they basically do the same thing. So the spot market has it kind of upside down to even the stock market. You buy stocks at $1, you sell them at $2. Here, you're selling it, you're buying at $2 and you're selling them at $1. So whenever you buy or sell for the spot market, things will get a little bit different than they would normally in any other instrument. Now, a market order, if you were just to buy, you would be paying the spread. Right in here is a little bit of a spread. So that's what a market order is. The market order means that you're instantly going to the market and you're paying whatever the market is right here. Once you do that, you could then move your risk to a stop loss and then, or target, I'm sorry, and here's your stop. So if you bought the market, you have a take profit here and a risk point here. Here is your entry. Basically, that is all you need. You need a stop, a limit, and a target. There is, let's see, trading versus investing. Guys, watch this, okay? Watch this. I'm going to show you something cool. Let's go back here. Let's go back here. So, trading versus investing. This is why we all trade and we don't sit there and invest in. Is this me or is it just doesn't want to draw a line here? There we go. Trading versus investing. Trading, investing. Let's just say over the period of a year, the market goes from $100, you buy stock, 100, and it goes to 110. All right. Or you buy it at 100, and it goes down to 90, or you buy it at 100, and throughout the 12 months, it ends up being 100. What does that mean? It means it did this. Okay. And what does this mean? And what does this mean? So you're investing. You bought a stock at 100. At the end of the year, it's 100. You bought it at 100. You sold it at 90, or it's at 90. You bought it at 100. It's at 110. That's investing. Trading is interesting. For instance, you have the opportunity every single day, and the market may go up 30 pips, down 20 pips, up 50 pips, up 30, down 20, up 70, down 30, up 20, down 70. So let's just say this happens during the course of a couple of days. You have 30 plus 20 is 50, plus 70 is 120, plus 30 is 150, plus 170. That's 240 pips, okay? So the market worked and gave you 240 pips of or $2,400 worth of opportunity, say during 2 days. I'm just giving an example. And over a course of a week, let's just say over a course of a week, the market gives you 300 pips of opportunity. $3,000 worth of opportunity over 50 weeks, you have $150,000 worth of opportunity that the pips have moved 300 points a week over 50 weeks, 15,000 pips. You got $150,000 worth of opportunity, and all you're doing is trading a $2,000 account. Okay? You're trading a $2,000 account, and because of the cycles, the market cycles are moving over a period of time, during the course of a couple of days, a week, for example, during that year, the market has sat and offered you $150,000 worth of opportunity on a $2,000 account. And you go in every week and you're making $100. You're catching 10 pips, $100, anywhere in here, right? You're catching that little profit right there, period. At the end of the year, you've made $5,000. This is the difference between trading and investing. For those of you that are on here that are investors and don't understand trading, you're just on here wondering, what's Chris talking about? Well, when you put your money in the markets, you have to sit and have to wait for it to do something. The stock has to go up. If the stock goes down, you lose. If it goes up, you make money. If it does nothing, you do nothing. But all this money, all this time, you're tying up your capital, all right? Just like this, you're tying up your capital all year round. Think of this as you own a store, okay? You own a store, and in aisle 1, you have water. In aisle 2, you have meats. In aisle 3, you have veggies. In aisle 4, you have frozen foods. And aisle 5, you have all the milks and dairy. If you buy everything in your whole store and you spend this 110, you spend $110,000 putting all the food in your store, you now wrapped up $110,000 of your money, right? Your money's wrapped up, $110,000. You have to wait until somebody buys the water. They buy the water, they spend $50. It cost you 20, you made $30, and now you got to replace it. Your money's always locked up. At the end of that 12-month period, that $110,000 in money you have invested into your stuff has made you a $30,000 profit. Your money's always tied up when you're dealing with a traditional business, and the same when you're investing into a company. If you buy Microsoft or IBM or I don't know, Amazon, over the course of a year, you're sitting there tied into that stock, and you just have to wait. With trading, you have to consider this like a small store. You're always moving the inventory. You're always moving the inventory. You get in a trade, you want to get out of a trade. You get in a trade, you want to get out of a trade. You get in a trade, you want to get out of a trade. You get in a trade, you want to get out of a trade. You want to always move that inventory. You want to roll it over all the time. The more money you have locked up, the less money you have to operate. This goes back to margin and leverage. With the standard margin and leverage, you're limited. With the 1,000 times, which you're looking like Trader's Way, you have lots of opportunity where you can have all these different aisles in your store. You're buying the EURUSD, it's profiting, good, out of the way. You buy the GBP USD, it's profiting, bang, you don't have to get out. You can continue to build up your portfolio and still have money left over that you could turn over. Get in a trade, get out of trade, get in a trade, get out of trade. You can't do that when you're investing. You can't do that when you own a traditional business. You just can't. Your money's always locked up. So what you want to always do with trading versus investing is you want to understand why, what the difference is. So the older crowd, and look, I may have, $8 or $10 million sitting around in an account that's giving me 6 or 8 or 10% a year. I don't touch that. I may have accounts where I'm buying large amounts of stock and I'm flipping it for a few months later. I'm turning over the inventory. I may have stuff that I'm doing on a very short-term basis. So I'm always turning over the inventory. I would say as you create wealth, yes, you want to put money into stocks and let it go, or you have money in dividends, stocks. You buy a stock, for instance, a stock here is you spend $1,000 on a stock, fine. And if the stock's going to kick you a 10% dividend at the end of the year, which means that they're going to pay you $100 at the end of the year, they'll pay you out in multiple quarters, just to have that stock. No matter what the stock does, up and down, they're still paying you. All right. Kevin O'Leary is huge on this, the guy from the Shark Tank. Huge on dividends. He's huge on it. He'd rather just leave his money in dividends. He don't care about the stock. It can go down or up. He's getting paid a dividend, a residual income for investing into that company. So there's different ways to do things. The fact is, with trading, you have the most potential to turn over the capital and create a profit better than if you were sitting and investing. But in all due fairness, for smaller money, yes, you could do that all the time. When you get bigger money, you need to place the money in areas where you will get some kind of passive income, whether it's a dividend, you're buying real estate, you're putting money into the markets, or you're getting higher amounts of returns, mutual funds, whatever it may be. But the bottom line is trading over investing one-on-one, yeah, you have higher risk with trading, but you have a higher opportunity. Setting up the charts and the platform. All right. Now, I'm not going to go to, yeah, you know what? Let me bring you right there. Let's go right to FXCM. I'll give you FXCM as an account. You can use anything you want. FXCM. All right. You go down here, MetaTrader 4. You download MetaTrader 4. It's all going to pop up. It's a simple install, and your charts are all set up. All right. Now, if we did a new chart, that's what it's going to look like. MetaTrader 4 is going to look like this. As soon as you set up the charts. It's also going to look like this, show all. It's going to show all of these symbols. So let's look at this. Setting up a chart platform in charts, how to use the charting tools, what is support and resistance, what is trend lines. I'm recording everything here. Everything's being recorded. The moment we finish our session, I'm going to update it. We're going to send it out to everybody in an email, and you could take your time and watch it. Okay, so if I'm a little bit ahead of you, please don't fear. I got everything done here for you. All right, so let's take a look. This is how the chart's set up. I don't want you worrying about your charts right now. Don't look at anything but my screen. Then when I send you the email, you could take it and you could work it exactly what I do. Fair enough? Don't worry about your stuff now. Just watch what I'm doing. Hold on a second. I want a little bit of water. A little break. Everybody, let's sing together. I love it when you call me Big Papa. All right, we're back to work. So let's get back to work. Number one, when MetaTrader first gets set up, it looks like this. I don't particularly like this. What I like to do is get my charts clean. So right click, and again, don't worry about this now. When you get the video, or if you're a guest, ask the person who sent you to give you the video. I'm going to basically make this a public video so they can hand it to you. It'll be on our site. You can have it. You right click, you go to properties. On the properties area, I like to uncheck grid, and I like to go to colors. I like to have my background white. I like to have my foreground blue. I like to have my bar up blue, my bar down red, my bull candle blue, my bear candle red. So my background white, my foreground blue, there's no grid, right? Bar up, bar down. Basically the chart is red, white, and blue, for lack of a better thought. I also like to set it up right here. It says candlesticks there. I like to go boom, boom, yep, go back. And now you have a perfectly white screen with blue and red candles. I like to keep those colors for the United States, call it England, call it Australia, whatever countries have red, white, and blue. So after September 11th, back in 2001, I used to use a black background and green charts. And when September 11th hit, I got all patriotic. And I set my charts up red, white, and blue, and I haven't changed them back for whatever reason. For me, it works. So that was the reason why I have black, red, white, and blue charts. Um, I'm not a guy that sits and reads candles. Quite honestly, I'm not. And I'm going to show you what, actually, I'll show you what candles mean. I'll explain that to you. But I'm not a guy who goes, I got a doji bar. Quite honestly, a guy named Steve Nissan came up with it. He's a great enough guy. And he wrote books and he sold books and he got rich with books. And whether the doji works or the upside down Kiyosaki or the sushi bar works, I really don't care. You know, it doesn't matter to me. He has his own way of doing things, but if he ever wanted to, him and I could trade one-on-one, and we'll see how that worked out for him in his candlesticks. All right. So let me show you what candlesticks are, and let me show you what the open, high, low, close bars are. So standard bars are open, high, lows, close. You're going to get the full gamut tonight, guys. For those of you guys that are new, I'm not going to leave any stone untouched. You just rock with me. All right. So in my case, I made the blue bars up and the red bars down. All right. So let's take a look at what we got here. Let's take any blue bar, eeny, meeny, miny, mo. My mother said to catch this one or something like that. So on the up bar, the dash to the left is the open. The dash to the right is the close. The dash to the left is the open. The dash to the right is the close. That's the open, that's the close. You can see here that the dash higher is where it closed and the dash lower is where it opened, and that's the up bar. The low of the bar is called the low, which is obvious, like Chinese restaurant. You know, what's in chicken fried rice? Well, there's chicken and there's rice, right? You got the high and low. The low is the low and the high is the high. The open, the close. The reversal is true on my red bar. Who would actually think to message me on my cell phone while we're doing a meeting? Nobody. Nobody that's in my company, that's for sure. So the bar to up here with the dash to the left is the open. The dash to the right is the close. Open, close. It's a down bar. And then you have the high of the bar and the lower of the bar. So already here we go. Open, high, low, close. And that's actually what it's called, the open, high, low, close bar. OCL, open, high, low, OHLC, okay? Open, high, low, close. Here, you can see the bar is green, and that's an equal of an open and close. Equal, open, and close, okay? There's some times where you got just the open and close at the same exact time. So, one more time. On the up bar, open, close. Open, high, low, close. Down bar, open, high, low, close. If we take the candlestick, and I know people don't know what the candlestick is, and you're going to know after I finish. Same thing, ready? On the blue bar up, or the up bar, the bottom of the fat part is the open. The top of the fat part is the close. I don't know how else to call it. So, and then you got the bottom, which is the low, and the high of the high is the high. And then you got the down bar. Open, close, 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 high, high, low, high, low. Simple. Don't make candlesticks hard. Open, close, high, low, high. That's all it is. And the same thing here. Open and close are the same, the high and low. All right. So we now talked about setting up the charts and its charting tools, the charts and the symbols. For those of you that want to do indicators, I'm going to throw an indicator in there. I'm going to show you how to do that. All right. So you're going to take this later on. You'll do your work on your own, and you'll see what we do. let's take, everybody likes to use a Bollinger Band. A Bollinger Band is intended for a 20 period and 2 standard deviations. That's normal. That's a normal Bollinger Band. You can, however, be a little bit creative. For those of you guys that actually trade and like Bollinger Bands, you could actually make this a 50, and you could change this, and you can give wider standard deviations if you have a wider ranging market. Okay, that's a Bollinger Band. People like that. You also have what's called an MACD. Here's an MACD. You drag it and you drop it. In here, it gives you standard 12, 16, 12, 26, 9. We always use a 3, 10, 16. I've been using that for 20 years. And don't worry about this, guys. Watch the video when you get it. For those of you that don't know this, it's very simple. When I set it up, I bring it, I grab it, I drag it over, and you have your MACD. I put 3, 10, 16. I change my colors, I drop it, and that gives me my information. Some people like to use multiple MACDs. Sometimes they use that standard 12, 9, 26. There's nothing wrong with that. A lot of people like to use the RSI. Using the RSI with the standard 14 is fine. There's nothing wrong with using multiple indicators if you know how to read them. All right. So I'm not going to get too deep into this here, but I'm just showing you how to set it up. You want to put a moving average right here on the left. What a lot of people do, a lot of traders do, is they have a 20 period exponential. Okay. They also take over the moving average, and where I could find the moving average. Anybody see my moving average? You drag it over and you have a 50 period simple. The higher time frames tend to work good with the 50 simple and also the 200 simple, like that. So where you got these higher time frames, traders like to look at these higher time frame symbols. Like right here is a 200 period moving average that the EUR USD has went to and dropped down to the 20 or whatever. A lot of traders like to use that. So you may see traders using the MACD and that's good. Quite honestly, this is all jewelry you don't need. All right, you really don't need it, but if you want it, put it there. You know what? Indicators are great. Here's what I suggest you do. If you're a guy, you go out, you take a picture of your chart, you're out at the bar, you show your girl you're talking to, you're trying to impress her, and she says, "What do you do for a living?" I said, "I'm a trader, baby." And she's like, "Really? You're a trader?" And you go, "Yeah. I look at the Bollinger Bands." And she's like, "Wow." And you're like, "Yeah." But sometimes I look at the stochastic. You see, the stochastics are really important. She's like, "Stochastics?" You're like, "Yes." If you watch the stochastics like I do, that's how you get rich. And she's like, "Can you teach me?" Do you understand, guys, what I'm trying to say? You don't need this garbage. It's garbage. You don't need it. All right? You don't need it. Look at price. Don't worry about it. As you start learning, believe me, you'll be in the game. So here's what I suggest you use. All right? And this is most important. More important than all the indicators. I'm only joking with the indicators, but reality is when you're a new trader, when you're brand new, you don't need that. You need to know a couple of things. What is support and what is resistance? That's all you really need to know. What is support? What is resistance? Price. What is support? What is resistance? All right, if I was to look here on the chart currently, all right, you guys like my impersonation of a girl in a bar? Really? Okay, so if I know how to stop this thing, all right, here we go. Get rid of this. And believe me, I'm not saying that I've picked up people before, girls in a bar with my stochastic story. Just telling you, just kidding with you. So here we go. This is support right now. This is support, okay? And this is resistance. You always want to look at all these highs and lows as key levels of support and resistance. Prices where the prices stop going up in the past or stop going down in the past. That's support. This is support. So for technical reasons, I want you to understand something right here, right? This two data points in trading is considered support or resistance. 2 data points in trading is support and resistance. 2 data points actually make up support and resistance. All right. Loosely, you could say this is support and that is resistance, but technically, with the bigger proper analysis, 2 data points make up support and resistance. Okay, 2, not 1. And lastly, no, not lastly, I'm going to show you how to use the tools also. We're going to get to that. To use the tools for MetaTrader, what I like to do is just basically, I'm going to leave it at this because you're newer, is you need to use 2 kinds, this one and this one, okay? This is your horizontal. So when you first get MetaTrader, when you first turn it on, it's going to look like this. Let me see here. I guess it's fine. All right, this is where it is. Hold on a second. Ray. Okay, when you first start it, it looks like this. Then I'm going to show you trend lines. So when you first start MetaTrader 4 and you use it, all you do is you take your line, it's going to do like this, and you're going to be like, that's not what Chris had. Double click it, right click, trend lines, parameters, Ray, common, and you make it thicker, you're good, okay? When you watch the video, you're going to have it. Now, watch this part. Trend lines are really important. A lot of traders get taught that you go from the body, okay? That you go from the body of the pattern, all right? That is not necessarily true. You always want to go from the wick to wick, like that. The high of the wick to the low of the wick. Here, like that. Whenever you're drawing trend lines, it should be wick to wick, all right? I know some people get taught body through the body. That's not entirely correct. Real important, it's the wick to wick, just like that. Always the wick to wick. Never, 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 never do the body to body. That's, look, right here. If I'm looking at a trend line, all right, because I look at candles, I'm looking at a trend line, I draw it down like that. That's actually picking up the wick to wick, all right? But if you go to candles, it's the same thing. So you want to always grab the wick or the end of the candle as a trend line. All right, so essentially we've covered what is Forex, what is the major pairs and crosses, what's margin leverage, how to use it, what's a pip, what is lot size, what is the spread, what the best sessions are to trade, what is a market order, a limit order, a stop order, take profit order, what is trading versus investing, how do you set up your charts, your charting platform, how do you use the charting tools, which you only need a couple to start, right? What is support and resistance and how to use trend lines. Let's just go one step further and let's understand this. What's all this up here? What's this M5? What's all this up here? Right here is the highest time frame monthly chart. You click on that, that's the monthly chart. You click here on the W, that's the weekly chart. You click on the D, that's the daily chart. The H4, that's a 4-hour. What does it all mean? Let's go back. Each bar is a month long. Each bar is a month long. On a weekly chart, each bar is 1 week in length, right? Each day, daily chart, each bar is a day chart. How long has that day lasted, that one day? 4-hour chart, each bar is 4 hours long. H1, M15, each bar is 15 minutes long. All right, so you have all that included there. So I like to do this, guys. I like to take my charts, and let's just do some windows. I like to tile my windows, and I'm going to show you how to set up a standard chart. From here, let's look again at, let's take a look at the navigator one more time. Let's set up a chart one more time. I'm going to show you how to set up a template. So you want to be a trader. Good. We're going to teach you how to trade. You set up your 200. We're going to set up your 50. Okay. We're going to set up your 20. All right. We're going to set up your 20 period charts. Up. I didn't mean to do that. One more time. Set up your 20 exponential. We got that. Now, guys, let's put in the MACD. We're going to drag the MACD one more time. We're going to go 3, 10, 16. Color levels are blue and red. You got that set up. And maybe you want the Bollinger Band. Everybody likes the Bollinger Band. So we're going to go through and put the 20 period Bollinger Band in there. And you got it. Okay? Let's just say that's the chart template you wanted. I don't care. I don't know. What you're going to do is you're going to say here, right click, template, save template, save as class. Okay? Now, let's set that up as a chart, and let's do a new chart window. Right click, template, class. Okay? You got that set up. All right, let's just bring this down a little bit further. Hypothetically, you're doing like this. I'm going to show you guys how I set up my charts and how you should set them up. All right, I do all this other stuff here just so you know, but I'm going to show you how I set up my charts, and we're going to wrap it up with exactly how I would have your charts set up. All right, not saying that I use all the Bollinger Bands and everything. I'm just saying is I want to show you how I would have my layout set up. All right, I do have my charts exactly how I'm showing you right here. What I also do is I add additional Bollinger Bands around it. Sometimes I pull them off, but I do have my moving averages. I do have my MACD. All right, but that's up to you to do what you like. So now you have a chart. I would say you have the ability to go you can do daily chart, you can do H4 chart, you can do an H chart, and you can do a 15-minute chart. So if I was to look at the charts, I would have all these charts set up. So let me just say I'm looking at the EUR USD. All right, you drag and drop, you drag and drop. So I'm looking at the EUR USD. I'm looking at multiple time frames now where I could do my analysis on the EUR USD, and I like to have 4 charts. I look at every chart as a different time frame. So if this is a buy down here, I then look at my other charts for confirmation. Like right now, I would not do anything, but the daily chart is showing a buy. I would typically wait for maybe a lower area to buy. So what I would say is keep your charts up here similar to this. You have your 4 time frames, and you're set up to trade. You know what a pip is, you know what a lot size is, you know what the spread is, you know what a market order is, you know what everything is, and you would sit there and be able to trade from that. And I've been able to accomplish that in 1 hour and 50 minutes. But I want to thank everybody for coming on here tonight, for being part of what we're doing. I'm going to now take this, save it, convert it, and once it's recorded, I'm going to put it on our email on YouTube. I'll put it up on our email. I'll send it out to everybody. I'll put it on YouTube, and you guys have a class from iMarkets Live, basically saying, here, rock and roll. Thank you for being part of our family. Thank you for joining. And I'm looking forward to seeing some of our people tomorrow in our room. Thank you, everybody who's attended, giving us your time. We love you. And tomorrow morning, come in at 8 o'clock Eastern to our live trading room. We'll do some Forex for an hour. We'll do futures for an hour. We'll do some trading for an hour. And, look out for those trades on the FX Signal Live to start kicking in. Look for stuff on the Harmonic Trader. Man, let's see what they got going on right now. What's the Harmonic Trader giving us? Not giving us anything right now, right? It's not giving us anything. It's still waiting down there. What for those who want to stay a little bit later right now and just watch some ideas, what I like to do. So let me give you some ideas, and then we're going to wrap it up. Let's just say that we are now in a buy zone on the GBP JPY. I wouldn't necessarily go in and buy it right here. I wouldn't do that. What I would do, guys, is I would let this market shift from going down to up. I would want to see this go up first, show impulse out of the way up, that first pullback. What I would look for at that point is that pullback to buy, because basically the market has been sitting in this range. What I would like to do is find a pullback. So there is nothing going on this particular higher time frame until we see this market shift up on the shorter term time frame and then give us a pullback. Because you've been building a base down here. There's nothing saying that you want to get in here. You want the market to shift first and then give you that opportunity to enter. All right? So keep that in mind, guys. Keep that in mind. All right? If you're using a scanner simple technique, this will keep you in the game for a very, very long time. Right now, the GBP JPY, I'd sit there, watch this. It starts shifting. Let it go up. Let it pull back. Be patient. No rush. Okay? So other than that, I'm going to wrap this up, and thank you once again. Guys, everybody else go to sleep. I'm in Vegas. No, I'm not going to go out. I'm going to get this recorded. I'll send it out in an email. Thank you very much. I'm going to end the webinar, but before I do that, I'm going to give you a big hug. I'm giving you a salute because our army is getting bigger, and we're helping the world. So salute to every one of you, and salute to those of you guys. I know we got a big team that's out there. They're in the military. They're protecting us, and they're learning how to trade. And we're doing whatever we got to do to make sure that you guys have financial freedom. When you get out of the military, when you're able to take care of your family, we got you. All right? We always got you. And that's about that. I'm out of here.